Before you pay $5,000 for a cost segregation study, before you chase bonus depreciation because someone on TikTok said it'll wipe out all of your taxes, you need to hear this podcast and listen to the story. A client came to me last year. He had spent $6,200 on a cost seg study for a property that should have never had one. It was a wrong property, wrong strategy, and wrong timing. And that mistake cost him far more than the study itself. And here's the truth almost no one online tells you. Cost segregations can be a wealth building accelerator or a completely unnecessary expense. It can wipe out taxes, or it can lock you into recapture that you weren't prepared for. Today, I'm giving you the exact framework I use for my own properties and for clients who invest in real estate, from single family homes to multi-million-dollar short-term rentals. And at the end, I'm giving you something that you need if you're serious about this. It's my free bonus depreciation guide that walks you through the math I use on every deal. Stick with me through the full episode. This one decision can save you tens of thousands in taxes. Most people hear cost seg and think big tax write-off, easy money, but let's simplify it. Cost segregation equals speeding up depreciation. It's not magic. It's not a loophole. It's not wizardry. When you buy a property, the IRS says that you get 27 and a half years to depreciate residential properties and 39 years for commercial. Cost segregation studies break down the property into different categories: 5-year components, 7-year components, 15-year land improvements. The depreciation lets you accelerate a big chunk in year one, depending on the tax year. That's it. It's not complicated, but it's incredibly powerful if used correctly. So when does a cost seg study actually make sense? And this is where people get burned. So let's lay out the 3 pillars that determine whether a cost seg is a yes or a don't waste your money. First is the purchase price. And here's a rule of thumb that I use. If your purchase price is under $300,000, you typically won't get enough accelerated depreciation to justify a $4,000 or $6,000 study. There are exceptions, short-term rentals being one, but in general, the bigger purchase price equals the bigger the benefit. 2 is your income level. If you can't use the losses, what's the point? For example, if you earn a $400,000 W-2, but you don't qualify for real estate professional status, you don't qualify for the short-term rental loophole, then your losses are passive and they just sit there and accumulate. You might do it to stack passive income, but wipe out the taxes now strategy is off the table. Cost seg is one of the most powerful tools when you can use the losses today. 3 is your hold strategy. If you're flipping in 18 to 24 months, then a cost seg is often a bad idea. Why? Because the recapture will come back and you won't have the rental losses to offset it. But if you're holding for the long term, refinancing, or stacking short-term rentals, the strategy becomes incredibly powerful. Now let's talk about short-term rentals versus long-term rentals. And this is where things really change for high-income earners. For long-term rentals, you need real estate professional status and material participation to use those losses against your W-2 or business income. And most people won't qualify. But the short-term rental rules are different. If your average stay is under 7 days, you materially participate, and you're not using a full service management company, your losses can offset any income. This is why short-term rental investors use cost segs to wipe out their W-2 income and taxes. But here's the nuance. If you use property management and you don't have hours, it's a red flag, and you must be able to tie that activity to you. That's the difference between paying zero in taxes and then getting crushed in an audit. Let's talk about risk, misconceptions, and have a little reality check. First is the audit fear. A properly documented cost seg with a reputable engineering firm has strong support. The real risk comes from inflated values, no time logs, sloppy short-term rental material participation, and using cost segs on properties that didn't need one. Second, depreciation recapture is not free money, but with smart planning like 1031 exchanges, step-up strategies, you can maximize or eliminate recapture entirely. Third is listening to your friend. My friend did it, so I should too. Everyone's tax situation is different. Different income levels, goals, timings. These changes. Cost segregation is a precision tool and not a one-size-fits-all. So let's go into some real-world examples. First up, we've got a client who had a single-family home, purchased it for $275K. The study cost $4,200. The benefit or accelerated depreciation was going to be $18,000, but the client couldn't use the passive losses. So the result is the cost seg was not worth it. Next up, we had a client who had a mid-size short-term rental. They purchased it for around $780,000. They were able to materially participate, had 150 hours plus, and the accelerated depreciation was over $120,000. They had W-2 income of over $120,000, and they saved on taxes around $40,000. Completely worth it. The third was a property purchase for $1.8 million, a short-term rental. The study costs around $6,800, and they were able to accelerate $600,000 and offset that in business income. This was a clear home run. Before I recommend cost segs, I usually ask 3 questions, and these can become your filter. First question is, can I use the losses now? Question 2, will the study produce enough value to justify the cost? And question 3, what is your exit or hold strategy? And if you can't answer these with clarities, cost segs becomes an easy way to evaluate it. If you're listening and you want me to run the numbers for you, schedule a cost segregation study feasibility call. We'll look at your property, your income, your goals, and I'll tell you straight up if it makes sense. And if you want the full breakdown on bonus depreciation, timelines, examples, download my free bonus depreciation guide in the link below. Don't let a cost seg become a status symbol. Don't use it if you don't need it, because someone online said it's a hack for the wealthy. Use it the way that the wealthy actually use it, as a strategic tool and a bigger wealth plan to build multi-property portfolios and to buy back time. They use it to reduce taxes today while protecting tomorrow. And this is how you turn real estate into freedom and not stress. Go schedule a discovery call, download the bonus depreciation guide, and let's build a tax strategy that supports your life and not the IRS. And please don't forget, like this video, comment if you've used a cost seg study before, and don't forget to subscribe to stay up to date on all the tax and asset protection strategies. My name is Anthony Brister. Thank you for listening, and we'll see you next time.